Simply learn. Your pace, your place.
Risk Management Applications of Option Strategies. Volume 6, Study Session 17, Reading 65, Derivatives. Welcome to Reading 65 of the Simply Learn CFA Level 1 tutorial. In the last tutorial, we learned about the various risk management strategies using option contracts. This session is on Reading 65 as prescribed by the CFA Institute Learning Outcome Statement, or LOS. We learned about LOS in the first session. Please go through the Learning Outcome Statement for a detailed list of learning outcomes. After this lesson, the candidate should be able to understand the basics of risk management and how we can apply the options to hedge market risk through various trading strategies. Agenda. The agenda of this session is to cover Reading 65 as prescribed by the CFA Level 1 curriculum. You can go through this reading from Volume 6 of the CFA Level 1 curriculum made available to you by the CFA Institute. As per the Learning Outcome Statement, after completion of this lesson, the candidate should be able to determine the payoff, profits, and loss from buying calls and puts. They should also be able to understand and calculate the profits, loss, payoffs, etc. from covered call and protective put strategies. Call. Let's now consider the payoff from call options. To understand the payoff, you need to understand that the payoff is not symmetrical, as the buyer of the contract has the option to exercise at the maturity date only if there is a profit. This option is associated with a premium that has to be paid up front in the form of option cost, C0. From the chart, we can see that the buyer of the call option is at a loss until the difference in spot price and strike price exceeds the premium paid up front. If the spot price is below the strike price, the buyer just walks away and his loss is limited to the premium paid, C0. If the price is in between the strike price and the break-even price, the buyer is still at loss, but some of the loss is offset by exercising the option. That is, purchasing at a lower strike price and selling at a higher spot price. Any profit becomes the loss for the seller of the contract, and vice versa.